Let's be honest. Taxes can feel like you're trying to navigate a crazy, complicated jungle with an old, torn-up map. But what if there was a brand new one? Well, that's what we're doing today. We're unpacking India's proposed income tax bill for 2025. And look, this isn't just a minor tweak. It's a complete teardown and rebuild of a law that's been around for over 60 years. So in this explainer, we're going to be your guide through this new landscape, turning a super complex bill into a clear, understandable journey. All right, let's get into it.
So, here's our game plan. We've broken this whole journey down into 5 basic stages. We'll start with the big why. Why do we even need a new tax code? Then we'll get down to basics. What actually is income? After that, we'll get into the nitty-gritty of calculating what you owe. Then we'll look at the actual process, filing, assessments, and, what happens if you disagree. And finally, we'll look at the consequences if things go wrong.
Okay, first stop on our journey, a new tax code. The current Income Tax Act is basically a relic. It dates all the way back to 1961. And over the decades, it's been patched up and amended so many times that it's become this famously complex beast. So the idea with this new bill is to just start fresh.
So what's the big idea here? Why go through all the trouble of tearing up a 60-year-old law and starting from scratch? Well, the reason they're giving is actually pretty straightforward. And here it is, straight from the horse's mouth. This is pulled directly from the bill's own notes. The stated goal is all about simplification. They want to make the law concise, lucid, easy to read and understand, which, for any tax code is, well, that's a pretty ambitious goal.
All right, on to the second stop on our map. Now, before you can tax anything, you have to define what that anything is, right? So let's look at the foundational language of this new bill. What exactly does the government now count as income?
First up, let's get a key piece of jargon out of the way. If you owe tax, the bill calls you an assessee. It sounds super formal and complicated, but really it's just the official name for any taxpayer, whether that's an individual like you and me or a giant corporation.
Next up, a category that always gets a lot of attention in India: agricultural income. The bill defines this as money that comes from land in India that is specifically used for farming. This definition is absolutely crucial because, as you probably know, this type of income often plays by a different set of tax rules.
And what about when you sell something valuable, like property or stocks, and make a profit? That's covered under capital gains. Now, the key word here, and this comes straight from Clause 67, is transfer. A capital gain only happens when you profit from the transfer of a capital asset. It's a simple idea that, believe me, can lead to some very complex calculations. Okay, so once we know what counts as income, we get to the real heart of the matter, figuring out how much of it you actually have to pay tax on. See, it's not just about what you earn, it's about what's left after you subtract all the legally allowed deductions. This is where the magic happens.
Now, the bill provides all kinds of different deductions based on who you are. And it's pretty logical, actually. The government wants to encourage certain behaviors. So for individuals, they give you breaks for things like saving for retirement in a provident fund. For property owners, they recognize the costs of owning a home. And for businesses, well, they let them subtract legitimate expenses, like employee bonuses, before they calculate their taxable profit.
Right, once you have your final taxable income, you bring it here, to these new proposed tax slabs. See the structure? This is what's called progressive taxation. The more you earn, the higher the percentage of tax you pay, but only on that next chunk of income. So someone earning 8 lakh rupees pays 5%, but if they earn more, only the amount above that gets hit with a higher 10% rate. The whole idea with this new regime is to offer simpler, lower rates, but in exchange, you have to give up a lot of those deductions we just talked about.
So you've done the math and calculated your tax. Now what? Well, our fourth section covers the procedural stuff, the actual rules of the road. This is all about how you interact with the tax system, from sending in your return to what happens if there's a dispute.
The journey of your tax return follows a pretty clear path. It starts with you. You file your return and do a self-assessment, declaring what you think you owe. From there, the system can take over with an automated, faceless assessment to check your numbers. And hey, if you and the system don't see eye to eye, the journey's not over. There's a formal appeals process where you can make your case.
Now, this is a really big deal that the new bill is locking into place: faceless assessment. The key point here, spelled out in Clause 273, is to completely get rid of the direct in-person meeting between you and the tax officer. The entire process, from scrutiny to notices, is handled through an anonymous digital system. The goal is to create more transparency and, hopefully, less hassle.
And that brings us to the final leg of our journey, the road hazards. What happens when you miss a turn, ignore a sign, or break the rules?
This section lays out all the penalties and consequences for not complying with the new bill. The bill is pretty clear about the kinds of things that can get you in trouble. Some are about, negligence, like just failing to get your accounts audited. But then there's the more serious stuff. Deliberately lying on your forms, faking your records, or even helping someone else cheat the system. And of course, the big one is misreporting your own income.
And yeah, the penalties can be pretty severe. For misreporting your income, Clause 439 spells out a penalty of 200% of the tax you tried to avoid. Let me say that again. If you tried to evade 1 lakh in tax, the penalty alone could be 2 lakh rupees. It's a massive deterrent, designed to make people think twice. So, as we wrap up our journey, let's just zoom all the way out to the big picture. This bill isn't just a series of small changes. It's an attempt to draw a completely new map for India's entire direct tax system, one that aims to be modern, consolidated, and, hopefully, a lot easier for millions of taxpayers to navigate.
The intention is obviously simplification, but the final outcome? That's still up in the air. So, the ultimate question remains. Will this new, shiny map truly simplify the tax journey for everyone? Or will it just create a new set of twists, turns, and complexities? I guess only time will tell.